What if the number on your Social Security statement might be completely wrong? Not because of a mistake, but because it doesn't account for 4 reductions that can affect many retirees. Today, I'm going to walk you through 4 ways your Social Security check might be smaller than your statement shows, and give you the strategies to minimize the impact. The first 3 reductions, many people can at least prepare for them once they understand them. But the 4th reduction catches even financial experts completely off guard, and it's hiding in plain sight in states you'd never expect. We'll save that revelation for the end, as it might change how you think about where to retire. Here's what we'll cover: the taxation threshold that many successful savers hit, the Medicare success penalty for careful planners, the timing decision that can cost you permanently, and the state tax trap that even financial experts miss. Now, the examples I share today are adjusted to protect our clients' privacy, but they're based on real patterns we see in our practice. Here's what can shock couples most about Social Security planning. The claiming decision that you make can permanently cost you hundreds of thousands of dollars. Let me walk you through a situation that reflects what we often see. This couple had accumulated about $2 million in retirement accounts and paid off their home. The husband wanted to retire early and thought, I'll just start Social Security early and get something rather than nothing. When you claim Social Security before your full retirement age, your benefits are permanently reduced. In this case, claiming early reduced his monthly benefit by $800 every month. And that $800 monthly reduction isn't temporary, it's for life. Over a typical 20-year retirement, this decision could cost around $200,000 in total benefits that can never be recovered. Fear can be what drives many of these decisions. People worry Social Security might run out, or they want to get something while they can. But what we've seen is that for many healthy couples, delaying benefits usually provides much better long-term security. If you can delay taking Social Security benefits past your full retirement age, your benefit grows by 8% per year until age 70. That's a guaranteed 8% annual increase, something you typically can't find anywhere else in today's market. But here's where many couples get caught. They don't realize that other income decisions can make even proper Social Security timing more expensive. Remember, this isn't about mistakes on your statement. It's accurate for what it shows. The issue is understanding what you'll actually take home. Preparation can help you keep significantly more of what you've earned. The second reduction can catch many couples completely off guard because many people think Social Security is tax-free. Here's the surprise. Depending on your other income, the government can tax your Social Security benefits just like regular income. The government looks at what's called your provisional income, basically all your income sources combined. Your Social Security, retirement account withdrawals, pensions, investment gains. In our example, this couple planned to take some money from their retirement accounts each year, and that seemed reasonable. But when the government added it all up, it pushed them over a certain limit. Suddenly, most of their Social Security benefit became taxable. This could cost them several $1,000s a year in extra taxes. The number on their statement didn't change, but what they actually keep became much less. Understanding this ahead of time helps with planning. Some couples make strategic moves in their early 60s that can reduce this tax impact later. But the taxation creates another problem because that same income can trigger additional costs. This third reduction often frustrates successful savers because it feels like being penalized for being a good saver. When your retirement income exceeds certain levels, you pay additional Medicare premiums on top of the standard costs. Remember, that same income that makes Social Security taxable, it can also trigger Medicare penalties. So couples can get hit twice for the same successful retirement planning. In our example, the couple could face additional Medicare premiums that potentially add several $1,000s annually to their healthcare costs. These premiums are deducted directly from Social Security benefits, further reducing take-home amounts. Many couples budget for standard Medicare premiums, but the income-related adjustments often come as a complete surprise. The couple might say, So we're being penalized for having retirement income? Unfortunately, that's essentially how the system works. If you're a successful saver with significant retirement assets, factoring these potential penalties into your income planning can help avoid surprises. You're learning the same framework our team uses to help couples understand what their Social Security will actually provide. The first three reductions, timing, taxation, and Medicare penalties, many people can at least prepare for once they understand the rules. But this fourth reduction is the one that catches even financial experts off guard. And it's hiding in plain sight in states you'd never suspect. Many people understand that the federal government can tax Social Security, but many don't realize that some states add their own taxes on top. And even more surprising, some states that advertise having no state income tax still specifically tax retirement benefits like Social Security. In this example, the couple planned to retire somewhere warmer with better tax advantages. They chose Colorado, thinking they'd escape their high tax home state. But what they discovered is that Colorado is one of about a dozen states that tax Social Security benefits. Colorado doesn't have a traditional state income tax, but it still taxes retirement benefits. This can add unexpected costs to your annual tax bill, even when you think you've moved to a tax-friendly state. The rules are confusing and can vary significantly between some states. Some states with income taxes don't tax Social Security at all. Others with no income tax still specifically target retirement benefits. It's not obvious, which is why even experienced financial professionals sometimes miss these details. If you're considering relocating in retirement, understanding state-specific Social Security taxation can help you budget accurately and avoid surprises. What our team has discovered over decades of client work is that your Social Security statement only tells part of the story. The actual amount you receive depends on your total financial picture, your other income sources, where you live, and when you claim benefits. The couples who often handle this best follow a systematic approach. First, they understand that Social Security will likely be taxed and factor that into their overall income planning. Second, they carefully evaluate the timing of Social Security claims. And third, if they're successful savers, they budget for potential Medicare penalties rather than being surprised by them. Fourth, they research state tax implications before making retirement location decisions. This isn't about maximizing every dollar or complex strategies. It's about understanding the system so you can make informed decisions and avoid surprises that could affect your retirement lifestyle. Your Social Security statement shows the gross benefit, which is valuable information. But now you understand the four main factors that can affect your actual take-home: timing decisions, federal taxation, Medicare penalties, and state tax considerations. The goal isn't to avoid all these reductions. Some may be unavoidable depending on your situation. The goal is to understand them so you can plan accordingly. If you found this helpful, subscribe for more retirement planning insights. Remember, retirement planning isn't just about avoiding mistakes, it's about making informed decisions so you can enjoy the retirement you've earned. Thanks for watching, and I'll see you in the next video.